Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. It's been a while since I've been in here and done a video, so we'll share some of my thoughts here today, and hopefully you like them. But anyway, today we came in this morning. Futures were down big after some turmoil in world markets, after the Bank of Japan decided to stand pat. The expectations were a little bit that the Bank of Japan might come in and introduce some new policy measures, either different rates or a new fiscal or a new monetary easing program or something to calm what have been really volatile Japanese markets. The Nikkei has been bouncing around all over the place. Yesterday, leading into the Bank of Japan meeting, the Nikkei was able to bounce back 5% after a really rough patch for that index. It had hit almost 20% off of the highs of the year, which 20% off the highs is what people generally consider bear market territory. But when you put it in the context of the fact that the Nikkei was up as much as 50% year to date, then you have to sort of take that 20% bear market territory idea with a grain of salt. And besides that, people expected Bank of Japan to do something. They didn't do anything, so world markets sold off. You had Asian markets down over 1%, both Japanese, Chinese markets. You had European markets down around 1.5% this morning, and then U.S. futures, S&P futures were down 15 handles. If you go to take a look at the chart of the spiders, you can see that we didn't get much of a bounce today from those pre-market levels. We did get a bounce in the morning, but we were unable to hold those gains, and so we're now back below the 8 and 21-day moving averages. And late last week, we had a nice bounce here off of the 50-day, which was a calculated area that we were watching for a potential bounce. Scott Redler was all over that. We were all over it in our morning note, off the charts newsletter, all the stuff that subscribers and even free people are now privy to via the morning note. But if we go back to the chart, you can see that that 50-day moving average coincided with the previous breakout level from this little pivot right here. It's where we broke out from. We retested it. It coincided with the 50-day. So that was our rationale for looking at that as a natural support level. But what I will say is that ever since this May 22nd outside day, the day that everyone talked about, it was the most bearish signal, I think, in the market this year so far, something has been different about this market since that day. We like to say that the most recent powerful technical signal is in control of the market until something louder comes in and usurps it. And there's been nothing quite as loud as that outside reversal on May 22nd. So that's why I, since that day, have taken a little bit more of a bearish stance on things. Even when we were building this wedge pattern, we talked about how some people could look at it as a continuation pattern from that rally that we've seen for most of the year. But because that May 22nd outside day was the most recent loud technical signal, we had a little bit more of a bearish tilt on that. And we got a breakdown out of that wedge. We got that breakdown into the 50-day. We did see a nice bounce, but the question now, obviously everybody's asking, is are we headed back down to that pivot low from last Thursday? Or can the market find its footing again and get back above its 8 and 21-day moving averages? And if you had the answer to that question, obviously you'd probably be a millionaire, but we don't, so we have to look at short-term technical signals to give us some clues on that. And right now the market's in a little bit of no man's land. But we'll take a look at a few charts. Yesterday the solars were really active, so we'll go ahead and take a look at that group. We'll start out with SCTY because that had a IPO lockup expiration today. People have to own the shares from the IPO for at least 6 months, a large portion of those people, and that lockup period expired today, if you're not familiar with IPO lockup expiration. So there's a lot of new shares that entered the float that could potentially be sold. We did see some selling pre-market today as SCTY was down with the rest of the market, but the wheels didn't fall off like a lot of people might have expected. It is bearish to see a break below this little consolidation, below the 8 and 21-day moving averages, which are now curling down, which are all bearish signals. But today it put in a little bit of a doji that, that's an indecisive candlestick. It tells you that it doesn't really know what it wants to do next. And the next level to watch, if it does continue to lower, will be that 50-day moving average around 30.33 is where it is right now. But this is something that I wouldn't really take a strong stance either way with this right now. You could see some more people pile out of the stock that saw their IPO shares, the lockup on them expire. But you could also see a situation like we saw with Facebook when its big IPO lockup expired, is that it squeezed people that were piling into shorts in anticipation of that expiration. So be very careful with SCTY right here. I would leave this to the pros, the short-term guys that make a living day trading, but just want to definitely keep on the radar if you'd like to play volatility. FSLR, the leader in the solar sector, traded off a little bit today with the rest of the market, which isn't all that surprising considering the massive move it had yesterday. I mean, it gave back all that move, which is not good to see, and there's a reason for that. Another reason for that besides the SCTY weakness that I'll talk about in just a second, but these are ones that they've come really far, really fast, these solar stocks, and I think they might be a little bit cooked, but if they do form another calculated pattern, there's no reason why they can't go. But after selling off today and engulfing yesterday's move, FSLR is not one that I would really be looking to buy into that 21-day moving average yet, but that time could come. LDK is a big reason why solars were down today. They reported earnings. Big move yesterday. The stock was up around 15%. It was one of the little guys in the solar sector that made big moves, and a lot of it was in anticipation of their earnings report. You saw a stock like JASO, which I'll go into in a second, made a huge move after its earnings report a month or so ago. So many people, I think, expected a similar type of move from LDK, and earnings were really disappointing. They lost more money than they were expected to, so they didn't even meet expectations that were already very low, and it gave back all those gains today, traded back into its 200-day moving average, back below its 8 and 21 days. So, weak earnings from the sector underscores the fact that the solar sector still has a lot of work to do to become a viable energy business and to be a long-term stock you can put in the drawer and not worry about it. These solar stocks still have a mountain to climb from a technology perspective and from an adoption perspective financially. We'll also take a look at a few stocks in mega cap tech, or big cap tech, I guess, that we follow a lot. Amazon, Google, and Apple are names that have been on our radar for different reasons. Google and Amazon have been two of the stronger stocks in the group that we talked about in the morning note today, ones that I would be looking to buy the dip on if you're looking to buy the dip on today's weakness. And then there's one, Apple, that has a little bit of a different story recently as a stock, obviously well-publicized sell-off over the last 8 or 9 months. And then you had the Worldwide Developers Conference yesterday. We'll go ahead and start with Apple just to get that one out of the way. Take a look at Apple today. It sold off yesterday during that Worldwide Developers Conference as they really did come out with some great new upgrades to their products, but there was nothing really game-changing at that conference that was going to ignite a big move in Apple. So, I think some more people jumped out of the stock. There wasn't huge volume or anything. So, not a huge red flag for Apple or anything like that. But, today it was down with the market early, paired some of those losses, and it's above its 50-day, but looking precarious. You also take a look at Google. Stock, was weak with the market today, but it's still one that if it gets back into its 8 and 21-day moving average, I would potentially look to buy the dip. Look at Amazon. Another one came back with the market today, erased yesterday's losses, which were an extension of Friday's breakout. It was one of the really strong movers on Friday. That was a great technical trade as it broke out of a longer-term upper-level range, or you can call it a bull flag, I guess, if you're looking on a macro basis. If we zoom out, you can see that upper-level consolidation, which is something that traders love to see. A nice move, but it's a little bit broken in the short term after today's move. You could see it correct back into the 8-day moving average at least, but overall, if the market does correct more, watch to see how stocks like Google and Amazon hold up. Those could be ones that you should look to buy in the dip. Google in particular, I think, is a really solid company that you can both put in the drawer and look for short-term momentum type trading. I think it's a really quality name. They're the new innovators in tech. Apple has sort of lost that mantle a little bit, but yesterday's upgrades were a nice step for Apple, but not anything that's going to change the game. And the streaming internet radio wasn't anything that's really going to contribute a ton to their bottom line, so investors weren't really too interested in that announcement. We'll also take a look at the banks. It's a sector we've been talking about as one that's been leading the market for much of the year and one to potentially see how it reacts to market weakness. And we really saw some troubling signs in some tech or some bank leaders today, like Goldman Sachs. The market was weak, so you can blame a lot of the weakness in individual stocks on that, but you don't like to see this big down candle like you saw in Goldman back down into its 8-day moving average. There was some news on Citigroup about losses related to currencies, and that weighed on the sector a little bit. Take a look at Citi. Obviously a big loss there for them today. This short-term pivot is one to watch here around 49.63. So watch that level to see if it holds. If it doesn't, I would think the 50-day moving average could come into play. Obviously, the technicals were looking pretty good on Citi this year until this announcement. News can obviously shake things up, and the banks look like they're weakening a little bit, which could be a bad sign for the market overall. We'll take a look at a couple things to wrap things up. Gold in the commodity space, it opened lower today, which was a troubling sign considering the market was down, because gold has traded inverse to the market often recently. So as some fear perhaps started to come in because of inaction by the BOJ, maybe you would think that gold would be up as people scrambled into that safe haven is what gold has become. But it was down this morning. It was able to pare losses into the close, but still finished down on the day. Overall, I still feel like gold is heading lower. Some gold bugs right now are saying this is a great buying opportunity and a chance for you to double down on your bet in gold and this and that. But I don't think gold is a very solid investment. I think it's very flimsy because it's completely, it moves around based on whims of supply and demand very purely, and demand does not seem to be very high right now. There's no inherent value in gold besides what people assign to it. It's not like a company that makes money and you can make money off their dividends and stuff like that. That's a Warren Buffett concept, but gold I think is heading lower in the macro. Take a look at TLT, the bond ETF. Today's move is something that I've been expecting recently in TLT. It started to happen a little bit last week, last Thursday I guess it was. You saw a big bounce in the TLT. I think that narrative about QE tapering has gotten overplayed. I don't think they're going to taper as quickly as people think, especially as data is not great. I know the jobs report last Friday was okay, but ISM was really dismal. I think sequestration is starting to take its toll, and I think that this head and shoulders pattern in TLT is not ready to go. I know it's something that Scott's been talking about, and it's the potential for the great rotation out of bonds and into equities. But I don't think that move's ready to take place, and I do think we'll see some more upside action in the near term in TLT, as I think in subsequent Fed rate decisions and minutes and things like that. I think they'll maybe cool it with that QE tapering concept, because I know definitely the chairman, Ben Bernanke, is not really comfortable with the term tapering and the idea of setting expectations of less accommodative monetary policy. But that's it for today's recap. Tomorrow should be an interesting day to see whether we follow through to the downside or get some sort of bounce after today's weakness. Obviously, world markets are having a big say in what U.S. markets are doing right now. It's a world market environment driven by monetary policy, which isn't exactly what you like to see. You like to see stock markets driven by fundamental data and actual economies picking up steam. And right now, everything's moving based on the words of a few individuals that are way too powerful. But we can't control that. All we can control is how we react to the price action, and we'll continue to bring you our analysis of both the broad indices and stocks that we think are in play and provide good opportunities. This has been your Editor-in-Chief, John Darsie, here for the Daily Recap. Have a good day.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.